Hey, what's up guys, Adam here, and in this video we're going to be taking a look at the differences between stock investing and stock trading and some of the misconceptions between the two. So without any further ado, let's get right into it. So when people hear the terms the stock market, investing or trading, one thought tends to come to mind, and that is a group of people all suited and booted standing on a Wall Street trading floor, yelling out prices at each other, trying to buy and sell, and looking at various different monitors with charts and graphs. Or they'll refer to films such as The Wolf of Wall Street or Trading Places that give a very theatrical interpretation of how the stock market actually works. However, though, in reality, the stock market is a lot different to that. In fact, a lot of those examples that I mentioned previously are a lot more digitalized now, so you haven't necessarily got a load of people yelling and shouting at each other on a trading floor. Since the turn of the century, a lot of that has all been computerized now, so a lot of the actual trading work takes place more online than over the phone or in person on a trading floor. And on the topic of trading, a lot of those traits that I've just previously mentioned were and still are more related to stock trading than they are with stock investing. So then let's move on to the key differences between stock investing and stock trading. So let's start off with stock investing, since the primary focus of this channel is mainly on investing. So you may or may not know, the process of investing is to buy into an asset and hold it for the long term in the hope that asset will grow over the years to come. In fact, some of you may already be investing and you might not even know it. If you work for a company and you contribute to a workplace pension month on month, then you're actually contributing to a stocks portfolio, because in that pension pot, that pot contains various stocks, funds and bonds that's set to grow over time. So throughout your working life, as you are contributing, you are building up that pot so you can draw down from that pot when you retire. So of course, pensions is just one example. This obviously applies to stocks portfolios as well as bonds portfolios as well. So the philosophy of buying into an asset and holding it for the long term doesn't just apply to the stock market, it also applies to the property market as well. Let's say, for example, you want to go out and purchase a property and hold it for the long term. In this case, that'll probably be a buy-to-let property or a HMO, for example. You will simply purchase that property, and then what you can do then is rent it out to somebody else, and they will pay down the mortgage on that property, and you'll also receive a monthly yield or income from that property as well. But alongside that, we're also looking to hold the property so we can get the benefit of the capital growth on that property. Now, both the stock market and the property investment market both appreciate over time. We know this from historical data. Now, of course, year on year, there's always going to be peaks and troughs, or years where the markets do really well, or years when the markets do really poor or even crash. We know this as investors, but as I said before, we're holding for the long term. So even if the market does crash, it tends to correct itself and then grow back up on a new trend line as the years progress. So bringing it back now to stock investing, there's a large array of different types of stocks that you can actually invest into, whether that be individual stocks, mutual funds, index funds, or ETFs. In fact, I did a whole video breaking this down, so be sure to take a look at that in the info card above. So with all that at your disposal, that allows you to decide whether you want to be more active with your investing or be more passive with your investing. So to be more passive would mean that you simply set your funds up ahead of time and you simply make the same contribution to those funds month on month without doing much change, almost like a pension. Now, with an active portfolio, you're choosing to be more hands-on. You may decide to do a lot more research around your particular funds. You may decide you want to change funds or stocks month on month, or you may change your contribution amount as well month on month. Right, so we know investing is all about buying into an asset and holding it for the long term. Now let's take a look at stock trading. Now, stock trading is on the complete opposite end of the spectrum in terms of time frame compared to stock investing. So with stock trading, we're looking to buy in on the same day and sell off on that same day, and we are monitoring the price swings that take place within that day. And usually with stock trading, we're looking to make returns of well over 50%, whereas with stock investing, we're happy to make year-on-year returns of around about 8 to 10%. Now, to use property as a comparison once again, this would be the equivalent of buying a property, trying to fix it up or add value to it, and then selling it off in a short time frame in the hope to make a high and fast profit. Now, unlike stock investing, where you have the option to make your portfolio active or passive, when it comes to stock trading, that is pretty much a completely active role, almost to the point of becoming a 9 to 5 job. You need to be constantly keeping a tabs on what is taking place within the financial news. Remember how I said in my beginner's plan to stock investing that knowing what's taking place within the news and within the media has a major effect on how the market moves? Well, take that thought and times it by 10 when it comes to stock trading. You really need to be in the know about what is going on a day-to-day basis when it comes to financial news. Failing to do that could cost you dearly when you are stock trading. So as well as taking qualitative information from the financial news, you also need to look into doing a lot more technical research and technical analysis. That then brings me on to the two key terms that you're going to need to know when it comes to stock trading, and that is profit set and stop loss. And these are basically two parameters that allow you to control the volatility of the transaction being carried out to make sure that you make a decent profit and avoid making a huge loss. So let's say, for example, you've bought in at £10 and you want to set your profit set to 20 times. That would be 20 times the £10 you put in, and therefore that would put the amount at £200. That would be your profit set. So as soon as it gets to £200, you will simply sell off at that point and take your profit. On the other hand though, you may set your stop loss down to -5 times. So again, using the £10 as an example, 10 times -5, that will give you a total of -50. So if the transaction reached down to -50, it would sell out at that point so you don't make a huge loss. So of course, a lot of that technical research goes into trying to adjust those parameters to make sure you can maximize your profits and reduce your losses. So as you can probably guess, stock trading then is a very fast-paced environment. In fact, a stock trader is more concerned about the current price of the stock rather than the business actually providing the stock. So they're not really concerned about how the business is set to do maybe years down the line. They're more concerned of what the price is today and where that price can move. And there's actually times where a stock trader might not actually know anything about the business at all. They're more concerned with the price of the stock and where that price can move to. So as a result, then stock trading is very high risk, and it gets even more high risk when we introduce the next term known as leverage. Now, leverage is a tool used in stock trading that allows you to get the full value of the stock while only contributing a small amount of your capital. So let's use the £10 example again. Let's say the value of the stock is actually worth £20. You would actually be leveraged at 2 times because, of course, your capital times 2 will give you the actual real value of the stock. So of course, 10 times 2 will give you 20. Again, if the stock price was worth £100, you would then be leveraged at 10 times because 10 times £10 will give you £100, which will be the real value of the stock. Now, this is where people have the potential to make a lot of money or lose a lot of money, because remember I said before, being highly leveraged means that you take full responsibility of the stock as if you bought it with your own full capital. So if the stock does really well, happy days, you're able to make all of the gains that stock has made. However, if the stock does very poorly, then of course you pretty much take full responsibility of the complete loss that stock has made. So to summarize then, when it comes to stock investing is pretty much a long-term game. Very rarely do you get to see any cases where people make any quick or fast wins when it comes to stock investing. Trading, on the other hand, you are there to make a high profit in a short amount of time. It is very time intensive, almost becoming a full-time job. If not, it will definitely become a part-time job fade. And it's also very important not to get tied up with these social media posers that will post on Instagram and say, oh look, here's how I went from broke to making £2 million within 2 months. Because a lot of the time those have been the very few people that have been very lucky when they've been trading, or they've actually dedicated their full time to trading and know what they are doing. And a lot of times they try to sell you into certain different courses for more people that were more naive. They sign up to these courses, try to copy what they do, and end up losing a lot of money. So it's very important that you understand the high risks that are there when it comes to trading. Therefore, it's really important that if you actually are signing up to these courses, you actually read between the lines and make sure it's something you definitely want to do, because there's definitely going to be a few phonies out there that are just looking to take your money and take advantage of the situation, because they know that in this day and age, people want to make fast money. So anyway guys, that's been the difference between stock trading and stock investing. Let me know down in the comment section which avenue you're looking to take, and if you're already down one of those avenues, let me know how you're getting on. So guys, if you enjoyed the video, you know what to do. Give me a big like down below, and if you want to see more videos like this based on personal finance, investing, or watching my journey to financial freedom and wealth building, be sure to hit the subscribe button down below and hit the notification bell to see where we actually upload videos to this channel. Anyway guys, it's been Adam here. Thank you for watching. Take care, and of course, I'll see you guys in the next video. Bye for now.